Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted again to be able to speak to accomplished UK fund manager Gervais Williams of Premier Miton. So good morning, welcome, and nice to see you again, Gervais.
It's a pleasure to have a chat with you, Paul. A lot going on, a lot to talk about. So that's very good news.
Yeah, no, it's great to have you back on the show, not least given all the sort of volatility. We've now got President Trump back in the White House, sort of like threatening tariffs on anything that moves. Also, we've had DeepSeek now sort of like unsettling the generative AI trade, plus the sort of the ongoing travails in the UK economy. But before we sort of run through your outlook for the rest of the year on the markets, I'd just like to say a big shout out to our sponsor today, Edison Research, and they do sort of like really good coverage of UK, US and European stocks that can be freely available. And I'd encourage anybody to have a look on their website, because actually this morning there's a very popular share, Filtronic, which is in wireless communications, that's just won a big contract with $21 million contract with SpaceX, and you can download their report from that directly. It's one of their top analysts, Catherine Thompson, I think it is, who's done it. So that's a good report to have a look at. I don't know whether you ever use the Edison reports at all, do you, Gervais?
I do. Actually, I rate them very highly. I think they're good. I know it's often funded by the company that's concerned, but the bottom line is they've got some good analysts. I think they bring some great insight, and a little extra research on some of these companies is really helpful, because there's not that much to start with.
Yeah, good. Okay, well, need a bit of research on the macro side. What's your outlook for small caps going forward for the rest of the year? Because we've had a pretty difficult and challenging last 3 years.
That's absolutely right. I mean, when I've spoken to you before, Paul, I've always talked about globalization evolving to nationalism and protectionism, and I think that's very obvious now. And the whole point about that is, whereas we had zombies which survived during globalization, the problems with nationalism, protectionism generally is there'll be winners and losers, and there will be losers, unfortunately, but that will mean more winners. And that's great news, actually, bizarrely, because it means the winners win disproportionately, but the losers unfortunately lose out disproportionately. And so it's very, very good for markets, very, very good for small caps, where they can hopefully win. And what's been interesting, really, just in the last weeks and months, is actually the FTSE 100 is beginning to break out. And we've been talking about that's happening. When I say breakout, it's outperforming, the large mega caps in the US, the S&P 500, all of that kind of stuff. Why is that happening? It's not because people love the UK. It's because nearly everyone's got a lot of capital growth, particularly very large positions in a narrow range of sectors. And just at the margin, with this uncertainty, the open-ended uncertainty of Trump, you're beginning to get people buying some equity income stocks. Only at the margin. Local sellers, of course, continue. International buyers are coming in. FTSE 100 starting to outperform, and we think that's just the start. We think it's going to carry on and on and on. And most particularly, small caps haven't been part of that trade. International buyers aren't going to buy small caps in a hurry, but you are seeing this differential between large caps taking off, small caps at this stage not taking off, and there'll be a big catch-up trade, not just because small caps are very lowly valued, not just because mainstream UK stocks are very unvalued, but because that differential gets so wide. And many of the winners are going to be the stocks we're going to be talking about, where the opportunities are, even if there is a slowdown in global growth, even if there's a potential recession, even if some companies do end up becoming insolvent, particularly some of the zombies, then basically that's going to give more opportunity to small caps. So I'm upbeat. I've been more upbeat now than I've been for 30 years. It's all coming in as hoped, and so yes. We only need the starting pistol, and it's going to be very exciting.
Yeah. Well, it's quite interesting, actually, because you rightly point out the FTSE's gone up of late, and that's despite there being continued UK fund outflows, hasn't there been? That's been like 36 consecutive months, assuming you ignore November, which was just an aberration. So it's really quite interesting that, in terms of, it seems as though the overseas buyers may be sort of like swamping the outflows from the UK equity funds.
That's right. I mean, the UK is obviously a small territory. US is 70+% of the global markets. UK about 4 or 3.5. So, the UK is still the third largest in the world, remember, of equity markets, still up there. But most particularly, even taking a tiny bit out of the US is obviously massive compared with local sellers. And that's why you get it. Clearly, local companies are also buying back their shares, and that's offsetting international sellers as well. So there's a combination of both. And as I say, once the pattern starts changing, as nearly everyone's very lowly weighted in equity income, that becomes self-feeding in the same way we've seen international sort of mega caps outperforming. And this is going to lead to the UK outperforming, not because of the UK, not because of the economy or the government. It's just down to the pattern difference, which is tremendously upbeat.
Yeah, good. Okay, well, if anybody wants to ask Gervais any questions, please put them into the chat bot and I'll read them out. We've got one stock. I mean, we touched on Filtronic has done very well, but actually we've got one stock of yours, which I think is your biggest, U Group, B2B service, sort of energy services and smart metering services in the UK to corporates, which has equally shot the lights out over the last 3 or 4 years. What's your latest on this business? It's obviously doing pretty well.
Yeah, I mean, it's a utility, so it's a bit like Centrica or whatever. It buys the gas, it rents the pipelines, etc. Obviously, electricity is their biggest product. Electricity prices have been easing down, so although volumes of customers keep going up, ultimately we haven't seen the sales growing as fast because per customer they sell slightly less. At other stages, the electricity price go up and they'll sell a lot more. But the bottom line is they are taking market share. Our view is they will continue to take market share. If you look back since 2020, then effectively you've had a stock which has outperformed Nvidia. And even now, right? Sales grew from 11 million 5 years ago to say 580 or so this year, maybe 750 in a couple of years' time. So the point is, it's sitting on 90 million of cash, market cap around 300 million, 7 or 7.5 times that kind of valuation. Dividends just starting, net cash balances. The risk-reward ratio appeared very much in their favour. I think if it wasn't for depressed valuations of small caps, I think the valuation would be even higher. And so, you've got plenty of upside potentially from here. In our view, that's why it remains one of our largest holdings.
Yeah. Well, you don't need, and when it comes to running a portfolio of smaller micro caps, you actually don't need too many winners. As long as if you get a couple of those, then it sort of like jumpstarts your rest of your portfolio returns, doesn't it? I mean, it's such a great company. Follow your winners, sort of run your winners.
That's right. I mean, obviously, the nature of it is as they get bigger, then obviously there's a wider range of professional investors who can look at it. And as there's a wider range of investors, then that obviously brings in new buyers. And ultimately, you'd expect the valuation to rise as well as the earnings. We haven't really seen that over the last 2 or 3 years because small caps are depressed, UK is depressed, etc. So we've still got that catch-up trade in valuations, plus obviously the opportunities to pick out the winners. I'm tremendously upbeat about the potential for the market at the moment.
Yeah. Well, another one which has done really well for you is sort of like financial cloud company Beeks that provides sort of like exchange grade software to the likes of Johannesburg and to NASDAQ, which is just recently one for high frequency traders and also for some fund managers. And it's really changed the economics for its customers to be able to generate a lot more income. How do you see this one? The shares have just done terrifically well.
That's right. I mean, again, it's good to see the share price moving up. This is a company which I think leads the world. I mean, we've got global winners in the UK. Sometimes their share prices are low, the valuations are low, and people think, well, they can't be global winners on that valuation. Yes, they can. The market's overlooked. I think Beeks is a global winner. As you know, the cloud exchange, the exchange cloud platform, I think is particularly very exciting. I think that's been verified to some degree, not just by Johannesburg, but particularly by the NASDAQ contract. Obviously, NASDAQ has many US exchanges, but they've got plenty of global exchanges. Actually, many of the other exchanges around the world could also use NASDAQ. Use NASDAQ already and could use Exchange Cloud. And of course, valuations come up. There's a lot of anticipation and sales growth to come through. But remember, Johannesburg, when it was installed they took Exchange Cloud on. Basically, what we saw quite very quickly was that led to extra volumes, and extra volumes meant they had to have an upgrade. They actually had to have 2 upgrades of their systems afterwards because of the extra operational efficiency. So the net effect is if we get that opportunity coming through in some of the NASDAQ exchanges, and indeed many of the others which are competing with NASDAQ will probably have to play catch up as well, then we think there's a real kind of thin sort of wedge which will get larger over time. Yes, the valuations come up. It's not as cheap as it was, but the actual opportunity is still, in our view, very substantial.
Yeah, they must have something really unique there to win NASDAQ. I mean, for a UK sort of tech business to sort of play all of that Silicon Valley and what's that, out on the West Coast, they've obviously got something pretty special.
Yeah, I think it's, having all these server farms with all the exchange, all in the same unit,
Yeah.
definitely improves the opportunity for the pricing engine to deliver productivity in terms of better pricing.
Yeah, good. Okay, we've got a question coming in from Ben Sharman. He's asking about Van Elle. I don't know whether you own that one at all. Do you? Gervais?
We have held it in the portfolios. We've got a very much smaller position than we had previously. We have taken profits. It's fine. It's got a good asset base. It just hasn't grown much. And at a time when there's so many other cheap stocks around, we've taken profits, well, probably losses in that case. We haven't made the money.
Okay, good. And then we've got one coming in from Trader Mark. He's asking about Galliford Try in the similar sort of sector, more of a contractor. But I think the shares have done really well, actually.
Yes, I mean, again, this just shows how overlooked some of the UK companies are. This is a company which is big, it's doing a couple of billion of turnover. It's a big company.
Yes.
It was a very small company in terms of market cap. In fact, until recently, a couple of years ago, you were able to buy the shares below the cash balances on its balance sheet. Actually, there was nothing. It was actually valued at nothing in terms of the core business. And yet the nature of it is actually that the leadership there, I think, have done a terrific job, not just in terms of obviously gradually improving the margin and the operational efficiency of the business, but particularly allowing the depth of the business to reflect uncertainty about risk. And so they've moved away from certain contracts which have an open-ended risk, and they've moved towards, water industry and that kind of thing, which has got contracts where they think the open-ended risk is much less. And that's led not just to upgrades, that's not just led to acquisitions. They bought a company called North British Construction from the receivership, but most particularly now with obviously all this CapEx expenditure, not just in the water industry, but across so many of our utilities, the share price come up. But even now, it's still got terrific balance sheet. It's been buying back some shares. But most particularly, we think it could continue to expand its margin. It had a capital market day last year where it suggested its margin might move from 2.5% to 4%. And if it didn't grow its turnover much, that would lead to substantial upgrades. Clearly, if they grow its turnover, that'll be even better. Terrific company. But again, just reinforce the point, some of these companies are so overlooked that they are literally too cheap for many people on the mainstream market to look at. As they get bigger, then obviously they become more noticeable and you bring in extra buyers and all the rest of it, and you get this kind of compounding effect. Yeah.
Okay, good. Let's move sectors. We've got retail, which again has sort of been a bit challenged of late. We've got Shoe Zone, discount shoe retailer on the high street. Has been a real sort of favourite of investors over the last 2 or 3 years. It came out with a bit of a profit warning, though, I think around about sort of Christmas time in terms of, seasonalities and also sort of like weather, I think, and a bit of now obviously we've got the NI coming in next year or this year from April onwards. How do you see this one? Very cheap, but it's obviously struggling a bit.
Yeah, the nature of Shoe Zone is that it's actually there aren't many competitors left. I mean, the shoe market, the shoe retailing market's been very, very difficult. Ultimately, it did done incredibly well. It's a vertically integrated company. In other words, it goes to the factories in China and imports them directly, and all the rest of it. Doesn't have many intermediaries. Even its website is written internally, so they make all the margin they can. But most particularly, as retail's been under a bit of pressure, etc. So we had taken very substantial profits. We had not sold all our holding very deliberately because we think this company will come again. And what we've seen recently, of course, is obviously disappointing trading. But if they're having disappointing trading, some of their competitors must be having very, very difficult time. It's got a strong balance sheet. It'll be absolutely there. I think the average lease length in its portfolio is only 2.5 years. So it can always come out of the leases which aren't working and move into the areas it is working. But most particularly, as soon as you see a turnaround, because there's so little competition, as soon as there's some improvement in demand or perhaps their competitors pull out, then effectively you can see this company coming to dominate the industry. We, for that reason, remain very upbeat about the company. Hence, we've retained a small holding. But much more importantly, we can now top up our clients' holdings as we see the bottom of that market.
Yeah. One stock actually bucking the trend in sort of the consumer side is Supreme, which does sort of like FMCG products with vaping and lighting, batteries. Recently bought Clearly Drinks last year and then Typhoo Tea actually just before Christmas. Right. But the shares have done really well for sort of affordable sort of quality sort of products. But how do you see this one going forward?
Well, I mean, it's built its success on corner shops. A lot of the corner shops, they bought the batteries and the lights and things, and then they gradually increased sales, particularly very dramatically with the vape products, which have come through strongly. That's going to become regulated. They manufacture their own. They're low cost, but I think the regulation will improve actually their market position rather than reduce their market position. But most particularly, they're a very commercial business. They take on new products. Clearly Drinks, which is a sort of soft drinks free of sugar type brand, they think they can sell an awful lot more product of that. And let's remind ourselves, people can make an extraordinary amount of money out of fizzy drinks. I mean, take Coca-Cola, for example. Now, to be fair, they're not Coca-Cola. I do understand that. But, let's not trivialize this. They've got a very strong brand. I think the Typhoo acquisition is going to be very, very successful for them. This was a business which wasn't very well managed. They can really take a brand like that and not just sell it through many of their established network, but particularly take it into the supermarkets, some of the international markets as well. The risk-reward ratio, I think, becomes a lot more attractive after that acquisition. Now, I don't want them to rush it, and they may have to invest before they get the cash payback. But what a terrific management team, what a commercial outfit. Generating cash, the ability to generate surplus cash going forward could be pretty exciting. We are, as you realise, very upbeat about it.
Yeah, no, I would agree. Got a follow-up question actually just on ShoeZone from Ben Sharman asking about potential Chinese competitors for sort of shoes importing, like Temu, I guess, and Shein. How I mean, I'm guessing that if they were going to be impacted, they'd have impacted them already. But do you see that as a sort of a risk at all?
Yeah, I mean, it is a risk, of course, because online is becoming a bigger part, and you can buy the products ShoeZone online. It's not a big part of their sales because actually, when people want to buy shoes, often they want to try them on. So it's a feature of area where actually, particularly for kids and stuff like that, back to school, all that kind of thing. So ultimately, you probably do need the physical network of shops alongside the online. What is interesting about their online is if you want to take them back, you just take them to a local shop, and therefore there's no return fee and all the rest of it. So actually, and then when you're in there, you might buy the right size shoes or whatever. So actually, I think in this area, I think there's less competitive threat from online Chinese as compared with other areas.
Yeah, I think their digital returns actually for ShoeZone, if I remember rightly, are about 11%. And I think the industry average for online is about 25 or 30%, certainly Boohoo and ASOS. So yeah, you're right. Their digital returns are very well done. Got a question from Omar Salama. Now, I don't think you still own the share, but he's asking about Avacta, which is the biopharma development company with AVA 6000 and sort of targeted chemo warhead technology. I don't know whether you've got any thoughts on this one at all.
Well, we have had a management change there, and that's often brings in new ideas, new opportunity, new energy. Certainly, that's where they believe they are. As you realise, we did take very substantial profits in the past. Yes. We took, sold it on the way down. We've exited entirely. It's not that we hate the company at all. Opportunity for companies like this to make a difference to people's lives is brilliant. But clearly, you've got to get from here to there, and there won't be any revenue for a while. And whilst the technology is, obviously past phase 1, you've got to do phase 2 and phase 3 and got to fund it, all the rest of it. And just right now, I mean, we are surrounded by companies disgustingly cheap. That's not to say that Avacta isn't cheap, but what we're saying is there's others which don't need more capital. They can do it without more capital. And from that point of view, we've chosen others for that reason.
Yeah. Okay, good. Another one you've done really well on is BuildTech software visualization and project management company, Eleco, that supplies this sort of like SaaS and cloud software to the build and construction sector for sort of the contractors and also for the house builders. How do you see this one going forward? Again, the shares have done really well for you.
Yeah, I mean, I think probably we would like to emphasise really that when Martin and I are selecting portfolio holdings, what we're really looking for is companies which are able to generate the opportunity not just to deliver outstanding levels of service to customers, but to have a very motivated workforce. Eleco is one of the best places to work, awards several times in a row. So that just demonstrates how well led the company, how well motivated the staff are. They've actually scaled up the opportunity. They bought a company called Best Outcome 18 months ago, whatever, which has now had a full year effect, and that's very good. They've made further acquisitions more recently. Vertical Digital, you'll know of, PMAC. Here's a company which is net cash. Has a very strong position with its clients, which are now extending the range of clients with its acquisitions. and had therefore the opportunity of scaling up and becoming a much more dominant company in its industry. As I say, I'm just immensely impressed by the management, the leadership of the business, to be honest, and the motivation of the staff, which deliver very outstanding levels of customer service, and that's just brilliant. Now the valuation's come up a long way. It's lovely. It's nothing like as large a holding as it used to be, but we are, again, we think there's much more to be had from that with the acquisitions recently.
Yeah. I must admit, one of the things I love talking to you, Gervais, is you come up with shares that I never, ever even think about covering, but they're fascinating when I do. And one of them that you mentioned that we should have a look at today is Guardian Metal Resources, which is basically an explorer of tungsten out in Nevada, the US. First of all, how did you find this one out? And two, what is the sort of the investment case on it? Because it does look fascinating.
So what's interesting, I mean, Martin and I, one of the things I think which, we have the advantage of is that we have a very large number of companies who want to come and see us. It doesn't matter how big or small. And so, the answer is as best we can fit it in the diary, yes, please, because we don't know. When I met Guardian Metal, I knew nothing about it, right? Yeah. But what is interesting about Guardian Metal is its onshore potential for mining in the US. And tungsten specifically, I don't know if you noticed when the Chinese sort of tariffs came on, one of the key areas they chose not to export to the US or to restrict exports to the US was in tungsten. So we think that actually tungsten is going to become an important metal. It's not so much used in light bulbs the way it was. It's used in a number of different, hard, metal hardening areas. But most particularly, we think, therefore, the US is going to be horribly interested in improving its own tungsten production. So that they had a mine. It's it's an established, I think it's Nevada or whatever, but it's most particularly it's an established mining area. They've got the opportunity to bring this into production. It may take 2 or 3 years. Clearly, that's going to cost money, but we think they'll get funding potentially from the US government. But what's been interesting about that, they've also gone around to make sure that they have the best potential tungsten mine. They found a second mine, which they also thought was actually very prospective. And so they've now brought that in. So that they've got 2 prospective mining operations. The second one, if anything, can be brought into production even faster. So here we have, a White House, which is very quick at making decisions. We think they will be very keen to actually have tungsten mined and produced in the US. We think Guardian Metals is probably one of the prime opportunity in the sector. Valuation has come up a little bit, but my goodness, if it got funding to support it, to accelerate its mining production, the upside potential remains very substantial. And that's the kind of thing. So coming back to your question, how do we come across it? We meet vast numbers of companies. We're very lucky in that. And this risk-reward ratio appeared unusually attractive for us. Hence, we supported them with the funding.
Yeah. No, I mean, I think tungsten is really interesting because it's a strategic defense metal. Not only is it, it's an energy transition, but because it also has things as copper in there as well in terms of its mines. But it's mainly tungsten is used in defence a lot for armor and protection and all this sort of stuff and missiles. And yeah, you can guarantee President Trump is going to have this one as has got to have security of his supply for his armed forces because he's a patriot and nothing else. Okay, we've got another one. Another one in the sort of commodities, but precious metals, Serabi Gold, which I think is basically an explorer and miner of gold in northern Brazil. It's very, very
That's right, it is coming into production.
Yes. Yeah. It's very cheap. And obviously it's a beneficiary of the gold price going up and central bank buying of everything gold. How do you see this one going forward?
Well, what's interesting about gold is that, people are less confident in central banks to leave their reserves in a foreign currency. We saw, obviously, with the invasion of Ukraine, that Russian dollar reserves, indeed, I think all Western reserves, were suspended. And so if you're a central bank, and it's not to say you're expecting to do any military action, but you just fall out with one country or another, you can suddenly find you haven't got your reserves. So gold is becoming a hugely more popular product for diversifying country reserves. Clearly, Serabi Gold is coming into production. Gold price has gone completely amazingly ballistic. Serabi's done very well. We have taken profits, a large part of this, but we've also got alongside it in the portfolio Pan African Resources, which is another South American gold mining company. Again, they're not just increasing the range of mine, and they're bringing some new mines into production, but obviously each unit of gold they produces that much profit. And so you're actually seeing combination of rising sales, rising profit, rising cash generation, and in many cases, as they get bigger, then obviously institutional interest is coming, because there's no real FTSE 100 stocks which sort of hit this box. So if you are wanting to back a gold company in the UK, you have to move into the mid caps and small caps. So all of that's very variable. How much further is gold going to go? Don't know. But it's already gone an awfully long way. And so it's been a very good diversifier. What we tend to have in our portfolios isn't just lots of good technology companies, not just good service businesses, but quite a lot of companies in some of the mining sectors, some of the complicated financials, where perhaps, a different pattern means that sometimes you can get lucky. And clearly the gold price has meant that Serabi's got lucky.
Yeah, going for gold takes me back to my university days. But there's also a lot of consolidation in that sector, and I think a lot of the bigger gold miners are looking for diversity of geography, and this is the kind of thing that it gives you that type of spread of jurisdiction. I think to allow you to grow, but not to be so over reliant on one particular region, I'm guessing.
I do agree with that. I mean, I think some countries may run out of hard currency in due course, and that may mean that some returns don't come through as expected. I think Brazil, which has its own, a lot of its debt is in Brazilian reals rather than anything else. So I think from that point of view, I think that's good news, actually.
Yeah.
Same with South Africa. I think it's less of a currency risk.
Yeah, good. Okay, we've got a question from Lemon Physical. He's asking about, I don't know whether you own it, CMC Markets, the sort of spread better that's moving into a sort of like a financial services platform that I think won a big contract with Revolut, actually, to supply its technology into Revolut so they can actually white label their products. If you do own it, and how do you see it going forward?
Yes. It's been one of our largest holdings. I mean, share price went completely, it got far too oversold at the end of 2023 and 24. Its share price just shot up, which is good. It's peaked out a bit recently, but not a problem. It's a very strong financial business. CFD operations are the core, but they've expanded it into a range of different sectors. And most particularly, they're going to be not just, supplying a wider range of customers, but most particularly they're increasingly bringing products to market, which can be sold as a platform. So, they have a platform in Australia and New Zealand. We think they'll develop a platform in the UK. This is a company where actually we find that that's unusually good, not just at looking after customer service, very, very high, but actually they've got quite a good understanding of risk. And so they manage risk really well. We're really quite impressed by the risk team. So net effect is the share price is vastly oversold. It's come up a long way. It may have peaked out, but most particularly they can put a Revolut platform. They can sell their products through Revolut in a way which a lot of others can't, because of the architecture. The software architecture is just so flexible compared with many of their competitors. We think this is going to make a big difference, because there's a lot more brands out there than there is Revolut. I mean, we can imagine all sorts of other people they could do deals with in due course, and many people would want to not just have their current account with Revolut, but actually put some of their savings in there. Possibly trade in terms of buying different funds or different ETFs or whatever. We think actually CMC is going to be a brilliant partner for Revolut, and we quite look forward not just to Revolut but many other partners over the next few years.
Yeah, I was looking at some stats for Revolut, and apparently they've got 10 million users in the UK. Or customers, and they've got 50 million worldwide, so you don't need to win too many of them of that sort of population to make a big difference in the bottom line.
I mean, and let's remind ourselves, that things like NatWest, Barclays, share prices doubled over the last 12 months, right? So these are not very exciting companies, and they're doing well. Some of the companies which are probably more growth orientated could do really, really well.
Yeah, well, I bet you NatWest haven't got 10 million customers in the UK, or that it's got to be that sort of number, because I mean that's like a sixth of the population.
I don't know. I wouldn't take you on with that bet. I don't know how many it is, but it could be more than 10, because a lot of people have 2 or 3 bank accounts, don't they?
True. You're right. Yeah. Okay, I'll let you off on that one. Okay, we've gone through some really good winners. We've got a couple of questions on some which haven't done so well, and what your latest thoughts. I mean, I know it's been in your portfolio for a long time. Kromek, which is a sort of specialist business that does CZT technology for sort of like X-rays, things like MRIs and spec technology in healthcare, and also for defense and How do you see this one? It just won, I think, a big sort of contract actually just recently, which the shares have done well. I don't know if you still own it or any thoughts.
Yeah, we do. We still do own it. There's been a long wait there, I must admit. I mean, the technology is great, so we're pretty excited about that. But specifically, they've been bringing this technology for CT scans. Now, most of the different types of scanner in the hospitals are CT scans. That's the big market share. There are others, but that's the big market share. And there is going to be a major upgrade in terms of, at the moment they can do some visualization, but with the Kromek CZT technology, they can not just get much high definition, but colors and all the other things. It's going to come, right? Yeah. And what's been interesting is we've been waiting for the product to actually come through to the market. Now, they did a tier one sort of customer deal about 2 years ago. They didn't say which customer it was. They haven't said anything more about it. But these customers really want to keep below the radar screen. So tier one customer one assumes is being very, very careful about what it says, because it's going to bring a new product to market. And when it comes, that'll be great news for Kromek. But more importantly, I mean, with the Siemens contract, that's really only for spec technology. That's the kind of slightly older technology. And they get $37 million in, right, for supplying some relatively old technology, right? Siemens, there's others, tier ones, which may need to come into this market. We think all of them will actually use these CDT eventually. Then we think there's 2 or 3 major orders to come, plus the tier one contract to come to market, which we think will probably happen in the next 12 months. The net effect is, I think that actually the anxiety about this one has been, one, the wait. Secondly, have they got enough cash? They've got enough cash now. We can take that off as a risk off the table. The opportunity for them now to actually use their platform to bring in more of this supply in the CT market, which we think will be the much bigger part of the market going forward, is pretty exciting. We are very upbeat about the company, and I'm very pleased that we've retained it despite the long wait.
Yeah, it's amazing actually. Some very small caps with fantastic technology do take a hell of a long time to come. I mean, just look at Filtronic. It's been around for 20 years and it's just suddenly moonshotted on the back of SpaceX. So people say, well, if they don't do it in the first 4 or 5 years, they won't do it ever. But actually, it can take a lot longer than that to effectively be the time. They're so before their time that the world hasn't caught up.
That's right, and power amplifiers, particularly for low, Earth orbit. SpaceX particularly, they've got terrific orders, and another one today actually has. Got
another question on a game which hasn't quite performed as well, from Steve Walters. He's asking about Inspiration Healthcare, which does sort of neonatal baby monitors and warmers for hospitals. Got a very good reputation in the NHS and sells around the world, and I think is looking for approvals out in the US as well, but with the FDA. But that's coming, I think, later on. Anyway, it sort of like had a big Middle Eastern order, which unfortunately hasn't yet. They've got the order, but they haven't actually delivered it.
Come through now.
Oh, has it?
The Middle Eastern's come through and it's delivered. Yeah, they've got the cash in for that, so that's actually came through. That came through the end of last year. Specifically, what they really did, they spent an awful lot of money on a major sort of upgrade of their facilities. They've got a better, operation than they had, and new facilities, and that was just poorly timed. Unfortunately, it was a time when, as you mentioned, the Middle Eastern contract didn't come through as expected. They nearly ran out of cash. They raised some money. The fund management changed. We have reduced our holding on the way down, just to be open with you. But most particularly, yes, it's still a world leader in its industry. We think it's terrific. It's got the foundations there. We think they will get more contracts. To be fair, our holding is much smaller than it used to be, not because we hate it or anything, but just because we can buy into all these other stocks which are going up quicker. But most particularly, again, a world leader, a small cap world leader, and doing wonderful things in terms of obviously reviving preterm babies specifically. Upbeat about it, but upbeat about even more perhaps some other stocks.
It's interesting actually. One of its shareholders, Menon Healthcare, Menon Medical, I think it is, who are a private equity backed consolidator in the sector, have just increased this morning. That's the 10%, which was quite fascinating. So given the M&A,
look at the share price. I mean, here it is. Look how far it's come down, and I'm glad you used logarithmic scale, because that really is very good in terms of showing how much these things have come down. We've got the last 3 years since May 2021, really. So 3.5 years, we've seen a lot of small cap share prices coming down, even when their prospects continue to improve. So the risk reward ratio for the UK small cap sector specifically, particularly as the UK takes off, is very exciting.
Yeah, no, I would agree. Okay, good. We've got another company that is it does basically specialist foams, Zotefoams, and I know it's got a big customer with Nike supplying into their sort of like athletic shoes. Did very well during the Olympics and stuff. It also had a sort of like a blue sky resource recycling, cartoning, packaging business that had high hopes, but unfortunately didn't quite get a strategic deal, so they had to shut that one. I think shutter it last year. But it's now trading. Yeah, it's mothballed it. Yeah, but it's now trading at about for mine 10 times PE. How do you see this one going forward, Zotefoams?
So it's interesting. I mean, we've had a change of management team, so a new CEO over the last 18 months, years. Specifically, I think the core technologies are very, very strong. This is a very strong, core operation, particularly in what's called azote. They call it the azote, the polyolefin things, which I think they could sell an enormous amount of due course. MuCell's been costing them money. They've closed it and mothballed it. So that's the thing. Core operations are continuing to trade above expectations. Nearly everyone just worries about the Nike footwear opportunities, which in fact did sell a lot more. I think they sold 46% more last year than the previous year. But that's not just the main opportunity. The azote opportunity, I think, is very exciting. What I worry about some of these companies is they're going to get taken over, right? We can suddenly find it's taken over 50% above the premium. That would be a travesty. This is a global world leader in its industry with incredible big long-term opportunities. Let's make sure, even if they do ever get to take over, and I don't want them to, we absolutely tell them to get stuffed. We don't want this company to be taken over. We want these kind of companies to see their share prices not just move up to where they were previously, but multiples of that in due course. That's the nature of the opportunity. So, yes, are we upbeat? Yes, we are. Did we see them recently? Yes, we did. Are we still, enthusiastic despite the MuCell? Well, in a way, reducing loss making actually probably means more profit. So very happy with that.
Yeah. Tell me about being sort of like takeovers on the cheap. My biggest position is Equals, which wasn't exactly the richest takeover premium I've ever seen. But never mind.
No, there's been too many of those.
We've
got to be very robust.
Yeah. Okay, good. We've got another question from a question from Gervais Tesk. He's asking about Ashtead Technology, which is basic. I don't know whether you own it. It's basically a offshore.
We don't hold it. No, we saw them at issue. To be fair, it's traded very well since issue. Share price done very well.
Yeah. Okay, fine. All right. Well, we'll give that one a miss for that.
I mean, it's fine. I mean, it's North Sea. Investment. Coming back a bit. They're moving elsewhere. I think there will be increased investment elsewhere. But we find other companies which we think have more upside.
Yeah, no, I think it's trading at about 10 times PE, if I remember rightly. So it's come down.
There's a lot of companies on even less than that. I mean, it's amazing. Really.
Yeah. Okay, good. We got a question on from Ben Sharman follow-up just on TP ICAP, which is the interdealer broker. It's got the I can't remember Parameta data business that it's looking to spin off out in the States. Still very cheap, actually.
Yes, I mean, data businesses tend to be quite expensive valuation-wise and P ratios. So it is a world leader in its industry. It's got the data, a bit like the London Stock Exchange. Clearly, they've got the data, and if they put an IPO of that would reinforce the value of that parameter business. Specifically, brings more cash in. But the real upside lies in this. It's the biggest, one of the biggest. They think that they are the biggest in terms of bond transactions, which is great. They're bringing in. If you make the acquisition of LiquidNet, it's taken a long time for LiquidNet to come through, but they've got all the integration with all the fund managers and with global banks coming onto the system, not so much just in terms of equities, but on bonds as well. Then effectively, you can expect them to become one of the most companies best suited to generate liquidity in the fixed interest market. That's the reason we hold this company. The opportunity for that to come through is very dramatic. Parameter, in a way, I wish they didn't have to sell it, but if they need to demonstrate value, fine, they're going to do it for that reason. The real value is going to be delivering real liquidity, additional liquidity to fixed income portfolios, which we worry about small caps and liquid equities in some of the bond portfolios, particularly in some of the tranches of the bonds. In credit markets, they can be very, very liquid. So bringing enhanced liquidity to that, is very, very good news. So as they get up to about 5 major global banks on that LiquidNet platform, I think they've got 2 or 3 at the moment, possibly 4. But anyway, as they get up to 5, we suddenly get critical mass take off. Yes, it's one of our largest holdings.
Yeah, good. Well, it's done very well for you, saw from the chart. Okay, another one which has done it equally, not maybe not quite as well, but certainly right up there, is Concurrent Technology, a specialist electronics, rugged electronics supplier into things like defence and emergency services and anything really requiring very high performance in difficult conditions. How do you see this one? It's certainly separated from it hasn't suffered from destocking or anything like that. It's just kept on going up, actually.
That's right. I mean, the key here is that the family management team moved on about 3 years ago. Miles Adcock came in. I think he's transformed its prospects, to be honest. They made some acquisitions. Phillips Aerospace, quite a small acquisition. I think very much enhanced their position. What they do is basically take plugged-in cards for the defence industry specifically, but others as well. And that's become standardized. So they've got a wider range of contracts. When they win a contract, it's not just the initial volumes. There's then often a 5 or 10 year, possibly 20-year supply contract following it. Specifically, they actually raised some capital at 65p, and now the share price is nearly 3 times that level. So it's come up a long way. But my goodness, I mean, if it continues to win, I mean, it got 22 design wins last year, which is a terrific run rate. They'd like to do even faster, even more. So are we upbeat? We are very, very upbeat. We happen to be the largest shareholder in the company. There aren't that many defense companies you can buy, which actually are global leaders in their industry. We think this company is a global winner in its industry. So much more for it to do from here. So yes, the valuation isn't as cheap as it was, clearly. But the momentum, trading above expectations, as you know, continues to be very strong.
Yeah, I think what amazed me is that when the winner have one of those design wins, it gives them almost visibility of repeat revenues for 10 years because that product stays in that particular. Nobody's going to take it out, and therefore it just keeps on churning it out for another decade.
That's right. They break one or two, and they have to replace them all the time. So and most particularly the actual kind of cradles they put them in have become standardized. You used to have different ones for different defense contractors. Now it's all standardized. So the range of customers they can serve now with their boards or the contracts they can apply for is so much more wide ranging than it was previously. So we're very excited.
Yeah. Okay. Good. Another one in that particular sector, but more in sort of semiconductor specialist, is CML Microsystems. It does sort of like communications chips and antennae for things like wireless 5G wireless broadband and fast applications and all this sort of stuff. And all things like digital radio is another one. It's got a really strong balance sheet, a bit of property as well. It suffered. The share price has come down, suffering a bit from destocking in the industrial semis space and stuff. But again, what's sort of like your view on this one going forward?
Well, I mean, it's private mobile radios specifically, which they tend to be a very big in. The industrial wireless comms, all that kind of thing. And it's in the past it's been more analog. It's got a digital operation now as well. And they've made an acquisition, the MWT acquisition, ongoing R&D. So they think that they've got the opportunity to really scale up considerably from here. We believe that too, hence we're invested. As you see with technology stocks, is when they do get into a purple patch, it can be very purple. We saw that with Concurrent. We think that CML has all the foundations in place. It's got the strong balance sheet. It's got the potential to sell some surplus land in Firering, all that kind of stuff. But then, if its products do get pulled through, as it likes to think they're going to, then again, we think this company will get a lot of more upside. It's again, these are companies which have a global market position, and the valuations are misleading in terms of that global market position. So when they do get a proper sales through, they were generating free cash flow yields of over 10% recently. Don't get me wrong, that's going down as they put more capital investment in and more R&D. But most particularly, that goes in to generate even more sales growth and more profits in the future. Yes, we're very much remaining with this one. We're very upbeat.
Yeah, it's got 70% gross margins as well. So if you do start seeing the top line moving ahead, then you're going to should get in theory a lot of drop through, I guess.
That's right. Again, the nightmare would be that these kind of companies get taken over. That's the thing which we're terrified of.
Yeah. Okay, good. We've got a real specialist here. We've got Windar Photonics. Basically, it's a specialist in LiDAR, laser technology for helping the productivity and efficiency of offshore wind farms in particular, onshore and offshore wind farms. So when the wind's blowing,
it's principally onshore, actually, just so you know.
Oh, is it principally onshore?
It's nearly all onshore.
Yeah. So basically, go on.
I was going to say it's about yaw. So you've got your wind, it's coming at you, and it kind of blusters, and it kind of comes a bit from the left or right. And if you haven't got your propeller, you're quite at the right direction, it's less efficient, but it also adds extra wear. So specifically, they're going in and going particularly onshore, particularly US. They've been rolled out to some customers for Vestas V82s. They're the impeller, and that's customers find that they get 2% or 1% extra energy out of that. It doesn't sound as though it's going to change anyone's life, but that's all profit. That's all profit, right? So for marginal outcome in investment, you can get improved outcome. So that really drives things, and customers have put them in. They found they really work well. Yes, please, can we have lots and lots of them? And of course, what's happening now is they're now widening the range of customers, not just US, but international companies. But actually, alongside that, they're actually bringing in other wind turbine manufacturers. It's not just Vestas, some of the others as well. So the opportunity for here to actually scale their customer balance is enormous. Hence, the share price has come on a long way. It is now generating some cash. It's obviously had some fundraisings along the way. We've supported those. We take the profits as well. But even so, a global leader. Actually, I remember it coming to market. It came to market about a bit over 10 years ago now. We didn't invest at that stage. We had to wait 10 years to invest in the company. When it got into, we pull through its customers. So it's a relatively recent investment, last 2 years or so. But it just shows, we do have these companies under the bonnet. And once they get near the finishing post, the opportunity to really participate in the upside is very exciting.
Yeah, and I'm guessing as it grows, there'll be a better or bigger data mining opportunity, because if it saves a customer 1 or 2% efficiency just on its own, then if you start benchmarking across hundreds, if not thousands, of different wind farms and whatever, then presumably you can optimize those particular ones, so you actually get, from rather than 1 and 2%, it's 2 and 3%. So there must be, the amount of data you're going to get out there, it's going to help the learning curve, I would have thought.
That's absolutely right. Actually, the digitalization of some of their database, which is very extensive, as you say, is quite exciting, and no doubt using AI possibly to improve that. We haven't talked about AI generally, but generally there are opportunities for this kind of company. I'm much more interested in AI in a limited kind of walled garden environment rather than just an wild internet. So this is the kind of area where you could get real productivity improvement. Yeah,
real specialization. Okay, let's move to another one which really has taken off. Ondo InsurTech basically does its leak bot device, and it's been funded by a lot of home insurance providers to put it into people's domestic homes. So when you do get a leak, it can identify immediately there's a problem, and hopefully identify where it is, so somebody then can come in into actually repairing. But they've won a whole series of big contracts around the world, actually. How do you see this one? The shares have done exceptionally well over the last 4 or 5 months.
Yeah, I mean, as you know, a lot of these small companies, marginal sellers, no buyers, share price goes down. Yeah, and then people just say, "What's going on here?" And you get marginal buyers, and that's what happens when you get marginal buyers from marginal sellers. So Ondo specifically, was particularly rolling out in Denmark. That's where it got its first foothold. Some UK, but mainly Denmark. US has been much bigger more recently, nationwide. Most recently, Selective Insurance have announced it. And then just recently, they've just had a pilot for Northumbrian Water in the UK. But specifically, what it does is when you put the leak bot on, actually, many of the insurance companies send a plumber to your house, because you may have a leaking tap in here and there. And basically, that just means that, it is not working properly. So they first of all come and replace all your leaking taps and lose all the rest of it to make sure there's no leaks, so that this thing works. And that's quite nice for insurance companies. They say, well, we come and stop all your leaks and all the rest of it. Then secondly, if you do have a leak, particularly if you're on holiday or anything else, drip, drip, drip in the loft or whatever, it picks it up and somebody comes and it saves a huge claim, basically. And so the cost savings from in just clipping this on the in pipe is very substantial. And that's why a lot of these insurance companies put it on. One, it saves them. Secondly, socially, we're not wasting water in the way we were. And ultimately, you're getting extraordinarily high net performance improvements. So when you look at it in terms of the feedback is incredibly enthusiastic from that point of view. So you've got very happy customers who tell all their friends about how marvelous your insurance company is. Needless to say, it's beginning to have a very wide traction. The valuation's come up. It's 46 million market cap now. It's not the valuation it was when it came to market, but most particularly the traction is now very, very visible. So now that you get that kind of congregation. Once you've got lots of the largest world insurance companies, others want to be part of it, and they roll out in bigger and bigger volume. So we think it'll become an absolute standard product actually globally in due course.
Yeah, I think the ROIs on this for customers are really high, which is why they're sort of like jumping out to put it on for the insurers. Okay, let's pivot over to the aerospace sector. We've got a company again I've never even looked at, Velocity Composites. Basically, I think they're an outsourcer essentially for expertise to help the OEMs, i.e. the likes of Boeing and Airbus and some of the tier one manufacturers like GKN, to manage all of the difficult sort of like composite materials to get lightweight materials into their aerospace parts. But that could be a right or wrong, I'm not sure. But anyway, I've never seen it. How do you see it, this particular business?
So what it really does is it cuts kits. So effectively, if you are to do a composite part for it's obviously mainly aerospace, but it can be other products as well. Then specifically, you have to have the right bits, and you have to put the glues in the right place with the right parts. So they cut it out. They're more efficient than most other people. There's less wastage.
Oh, I see.
It's ready to go. They tend to have the output in terms of the product at the end. It's more likely to be in the specified range, so you get less wastage. But most particularly, you get higher throughput. That's where it really was. As you know, Boeing and Airbus basically are really struggling to produce the aircraft fast enough for the moment.
Yes. And
for them to have a company like this helping them, one, to produce more reliable parts, but particularly to supply bits faster. Some of the complicated bits faster. So they are getting real traction now. Of course, there's defense application as well as the military, as the civil aviation area. They are getting product through. They are now looking to scale up, get into cash flow, get into making substantial profits. We think the period of key risk, i.e. getting the volumes going, is now passing. They are getting the contracts through. And as I say, I think it's making a big difference in terms of the customers they serve. Many of those are GKN type companies. So very exciting, yeah.
Yeah, good. Okay, good. Let's move to one I think you've been selling or reducing your position is Cavendish Financial, which is the old Senkos stroke FinCap business that has obviously, because of he specialised in small caps, is a difficult industry with regards to repeat revenues and transactions. But if we do see a pickup in IPOs, hopefully at some point in time, or capital markets activity, then it should do well. I'm just wondering your thought process about why you've decided to reduce sort of Cavendish Financial.
Yeah, it's a good company. Nothing wrong with it. And as you say, when small caps succeed, it succeeds. That's great. We think the UK is well positioned to succeed. We think small caps well positioned to succeed. But as with all of these things, you've got to keep alive, and you've got to pay for staff all the way through, and that's been draining their resource a little bit. They've got less cash than they've got net cash, but they've got less cash than they used to. Yeah. They've had to make quite a lot of staff redundancies after the merger with FinCap. It was originally Senkos, as you say, merged with FinCap. It's still got a very good customer base, but obviously the companies delist, there's fewer of them. They're having to compete a little bit harder. Nothing wrong with it. We like it. And if the small cap sector not just recovers, but then there's large numbers of takeovers and specifically new issues, then we think it'll be well positioned. Well, we sold it. It's just other things are going up more. There's nothing more than that.
Yeah. Okay, good. We've got a really tough question for you now, Gervais. Looking through your crystal ball for the rest of 2025, what is the sort of the one or maybe two stocks that you think are really sort of like, when you've got a whole hatful of them there, that sort of get the pulse racing for the rest of the year?
Well, actually, I mean, I'm not really allowed to pick, so I can't pick winners or whatever. But I can talk about some of the companies which we've got in the portfolios where the risk-reward ratio appears very strong. And you know, there's kind of companies which are just overlooked completely, like Virgin Wines. I'm not saying it's the top pick, but it's, you know, you're buying a company there which is growing its sales, profits, and everything else, where you're buying in a cash balances. What a wonderful thing to be doing, you know. When you're buying it at cash balances, you know, theoretically there's no downside. Obviously, it can still disappoint, but generally, you know, and the risk-reward ratio is very strong. You've got companies which are recovery, things like Shield Therapeutics, which has come all the way down. You know, it's Acufer. Iron replacement treatment, I think, is market leading. Again, pretty, you know, we're very upbeat about that. Clearly, they've been worried about whether they can fund it getting to the finishing post. They've taken extra funding on. We're very upbeat about that too. Perhaps a company where, you know, you've got potential kind of world, you know, position coming forward. So Zephyr Energy, they've got this massive fairway in the US, where, you know, they're drilling a well right now, and we think that will actually verify the geology as they understand it, and the opportunity for the you know, having this extraordinary new area of energy to come to the market, including other things like helium. Probably the one which, you know, is probably the most people have never heard of is Firering Strategic. So Firering Strategic is in Zambia. Now Zambia isn't risk-free. You know, they could run out of money. They took on, I think, from a lot of kit which had been put in there, you know, by a major which was operating in the area. They spent 100 million on these kilns, basically they're lime kilns, quick lime kilns. And they had to move out of country for various, well, not out of country, but they moved away from this project. So Firering has taken it on. It's less than 10 million market cap. They're just bringing the first lime kiln into production. They've done the volumes in terms of, you know, all the logistics. Now they need to just turn the thing on, which probably happen in the next couple of months. And then when they do that, they generate cash, more cash. They generate some cash already, but they generate more cash. And then they start unpacking all the other kits. So they've got 8 potential lime kilns to come on stream. Amazing. I mean, they could make a lot of money. This is a product with, you know, as I say, Glencore, whatever, spend 100 million on all of this. Specifically, actually, you know, if you were to buy the same kit now, it would probably cost, I don't know, 180 million or 200 million, I don't know what. So they've got all this to come on stream. And then once that's all on stream, they've then got a cement kiln, which they can unpack, right? So, I mean, extraordinary, just completely extraordinary. Clearly, we've got to see the cash generation. We've got to see the new lime kiln come into production. But you know, these are the kind of things which are just very, very overlooked. And all of us, you know, as I say, along with Virgin or Shield or Zephyr or whatever, you know, the risk-reward ratio is just truly astonishing at the moment.
Yeah, what's the ticker on that? I couldn't find it on the. It was so unknown. I couldn't find it on my platform. Do you know? Was it
it's all one word.
Firering?
It's Firering. Firering. Yeah. It's all one word. It's FRG.
Yes. Okay, FRG. Brilliant. Fantastic. All right, well, brilliant. Thanks very much for all your insights and ideas there, Gervais. Plenty of things that people can have a look for. Go away and do some research themselves. And best of luck with all the investments, and look forward in touching base again in 6 months' time.
Well, it's very, very lovely to see the UK, you know, coming up, outperforming. We haven't seen that catch up with small caps. I'd love to see that. But most particularly, you know, our job is to help many of these companies succeed. You know, we've got fantastic management teams, often in fantastic positions, and they only need, you know, financial support. And that's an area where we, you know, between us, you, me, some of the other clients, can really make a difference. It's a wonderful opportunity.
Yeah, brilliant. Okay, great place to finish. So thanks a lot then, Gervais.
Thank you very much, Paul. Very much appreciated.